Welcome to another episode of the Lightspeed Investing Podcast. I've got my friend Shane here from Shane Seo Capital joining us from Atlanta today. How are you doing, my friend? Glad to have you back.
Doing good, man. I always love your energy, Philip, by the way. Even before we start, I was like, man, I'm always just awake and ready to go.
Good. You got to be ready to go to war every day, you know? That's what it is, man. Go to war and not just try to fight, but conquer the goddamn territory. I'm excited to bring you on because in terms of territories, not only are you in real estate, but you do it in a really unique way. I know we have an overlap in mentors in Grant Cardone and other people, but, Grant utilizes a specific dual approach with his current fund, right, which is combining real estate and Bitcoin. You took a similar approach and you've actually combined real estate with the film industry, right? And on top of that, you're also part of the M&A and private equity group. So last time when we got together, we talked about how you got into entrepreneurship and what is it that that drives you to keep doing what you're doing. This time, really, I want to go into an overview and description of what exactly it is that you do and how do you make yourself different from everyone else, because you're already uniquely positioned, but I'm curious, how can you take that even further? But yeah, man, I mean, if you want to share with the people, like, how is it that you can diversify your investors' risk tolerance approaches, right? By offering them both the steadiness of real estate and the film industry. We'd love to hear more about it.
Yes, I mean, our whole brand is called Good Investor, and our slogan is a good investor is always learning. And the reason I came up with this is because I realized that I always met people either in real estate, the film industry, or any type of businesses, and they always said, I've been doing this for 30 years. And it's not that they haven't become successful, but it just feels like they never actually got to the full peak of their actual potential.
Yeah.
And so it showed me this. A lot of people are visionaries, but not many people are vision doers or vision makers at that point, right?
Okay.
So in the same context, when it came, whether it be real estate, mergers or acquisition, or this film fund that I'll make sure I cover, is I always, again, like we said, a good investor is always learning. Is I always want to learn and evolve as things change and modernize. Okay, I know a lot of, it's kind of like building the same Honda Civic from 1995 and building the same one without changing a thing. Eventually, people are going to stop.
Yeah. If you remain stagnant, you're basically dying.
100%. What settles goes to the bottom. That's what we always say. So in that same sense with the fund, I mean, I was given so many movie projects for people, they wanted me to look at them. And I said, there's no way I can invest in these type of films. We're Seventh in the Waterfall, or there was no clear pathway to how I'm going to get a return on my investment. It seemed to be like dreams. They're creatives. They're not business people.
Right.
And I was like, I don't know why people invest in movies, just to be quite frank. I said, man, it doesn't make sense. For example, there was a $30 million film. They were wanting us to give in just $3 million of it, like 10%. And I did the math, and they would have had to make almost $120 million before we would even start making money. I just said, it doesn't make sense at all. I mean, at all. So I was talking to a friend. I said, well, why do people invest in these films? His name's Austin. He's the president of the American Film Association. And he said, Shane, if you help investors break even on their investment, they'll invest with you forever because they want to walk the red carpet. It's an expensive mastermind. Right? They like access, and you just meet people, and it's just, they're passionate about that room and that film and that kind of group of people. And I said, man, that just sounds crazy, And then I said, well, why don't we return to the old school days of a hedge fund and hedge the bet of the investment? So basically diversify. Also do it kind of like an insurance company. So whenever you do it, buy a life insurance policy, they, you pay the premium, right? And they buy income producing real estate. Someone dies, they pay it out with the cash flow. So I said, well, let's do the same. So basically, we decided to structure something very similar. I flew out to see Grant Cardone, spoke to him about his fund because he has a Bitcoin real estate hybrid fund. Mm-hmm. And we just I tweaked it a little bit basically, but it has some of the similar concepts, is that some of it is diversified in real estate and then the other amount into this very volatile asset, which is film, or in his case, Bitcoin. And if the film goes down, at least the investors are just getting paid, and we can kind of hedge some of their money. If they both go up, then they have a upside on their capital on the movie side even more, and the real estate. So to me, it's just a better way to kind of reduce some of the risk.
And how many people in the real estate business or investing business that you know of that have also introduced film as a secondary and blended asset class?
Honestly, none. That's the short answer. The long or little medium answer is a lot of people say, well, we have real estate, but our studio owns some property, or our studio does distribution too. But that's not the same thing.
No.
We're buying property with a lot of equity, and we're adding value.
Yeah.
And,
right.
And it's cross collateralized basically within the fund. That's what gives the protection. So sadly, I haven't met anyone that's doing it yet, to my knowledge.
So there you go. Well, that answers the normal question is, what industry are you in and how do you separate yourselves from everyone else? Yeah. Here, it seems like you are the only option. So good, bad, or indifferent, they got to go to you if they are especially into both film and real estate, right? Now, it sounds to me like the people that are getting into more so like the creatives, the film enthusiasts, they are advocates of the experience first and foremost. They are enthusiasts of the entirety of what it has to offer, not just a monetary and financial gain, but it's like a lifestyle, it's a social, right? And exactly. On top of that, they can benefit from certain tax advantages and perks, right? You want to break that down?
Yeah, absolutely. So like you just said, is usually people film, they'll invest directly into the film to have the rooms, have the perks, red carpet, some tax advantages from time to time. And I mean, that's great, but why not have a return too and do it a little bit smarter way, like a more sophisticated investor would? So they get best of both worlds by investing in something like ours. But yeah, what kind of opportunities do you get by being in that room? A ton. I mean, we've met some great people. So I love masterminds. So it's kind of like a film version of a mastermind,
Yeah. So, I mean, what kind of people would you say are suitable for this style of investing? Are you talking about, or the most suited for this? Are they like the Hollywood directors? Are they film actors, actresses? Are they,
anyone? Honestly, this is the cool thing. It's kind of like me and you, entrepreneurs,
okay,
or family offices. Any accredited investor or higher base. I think sophisticated investors, this is a vehicle that they'll look at and say, okay, this makes a little bit more sense than me putting it in and wonder if it's going to work kind of thing. It's kind of like that's it. I think it's going to be more attractive. So if you make it more attractive this way, more money will come in. And then for the filmmakers themselves, since they're creatives, they would do it for free because they're passionate about their craft. I mean, they love making movies. They would do it for free if they could. But in reality, they got to eat and they got to have crew. And you want to have the best cast, you have to have the capital. So I think it's good for everybody, in my opinion. You should do it. I mean, how good would it be for you to be in a room and you have like some of the top celebrities in there and you're in there mingling with them and, sitting at the dinner table with them. You never know what opportunity would come out for you too, or you could get them back.
Right. Yeah. Well, but that's, like I said, right, that's definitely true, especially if you're really into films and you're really into the whole Hollywood culture, right? Like for me, I'm all about the NBA, right? I'm, like if you said the exact same thing, but you're like, not hedging your investments with film, but hedging it with NBA teams, then it's like, yeah, you got my attention, because then I know I'm networking with like fellow NBA athletes, owners, et cetera, right? But in regards to this, so normally there's 3 segments to investing, right? There's the barrier to entry, like in real estate, how much down payment you're committing to. What is the runway, right? The time frame for you to actually see the investment dividend and ROI get realized, and then the actual ROI itself. Do you want to speak about those 3 segments, right? Starting with the barrier to entry.
Sure. Again, for the film fund specifically, which I'm not really giving an offer. I'm just telling kind of how we're kind of systemized. So we have a minimum amount $500,000. Again, this is for accredited, sophisticated investors, right? The moment that they put it in the fund, even if we're 4 months out, 8 months out, or 2 days out, they're accruing a not preferred interest, but a fixed interest per per year. So the next day they'll see it tick up. Every day it accrues by the day. So automatically they're already accruing because of the real estate portion that we're putting it into, right? And the film, I mean, that one's a time frame. So basically it'd be like if you gave $1 million, Philip, and I said, look, you're already gaining X amount, which I would say is probably be around 4 or 5% fixed annualized return on a daily accrual. So you'll be able to see it grow each day. And then the other, I don't know, 400,000 or whatever, let's just say we put in the movie, that may not show anything for 8 months to a year and a half. You see, so it's because there's two different products in there. And we may even add a mergers and acquisition thing in it, because the film business is the only business that hires every type of business, from chauffeurs to caterers to carpenters to everything. They hire every type of business. So we may add a compartment there that through our other, I guess, groups, they kind of like, since we work with studios, independent filmmakers, or people that we kind of work with, we can just say, hey, look, you have to use these businesses. They're exclusively used through this studio. So we'll be able to actually grow the NOI or the EBITDA on those anyway, and increase those too. So we may add that in there as well later.
So just so I'm hearing you correctly, right? The barrier to entry, the minimum commitment to get in is $500,000. You got to be a sophisticated $500,000. You got to be a sophisticated and more accredited investor to be in a position to play this game, first and foremost, right? Secondly, because there's two aspects to it. And by the way, the real estate, is it commercial? Is it residential? What?
We're doing multifamily, commercial, and we, in commercial is kind of broad, so I can keep going, but we are going to throw in some hotels specifically in some of the areas where the films are going to be made too.
Okay, so the real estate is mainly multifamily, residential or commercial, and also hospitality industries, right, with the hotels. Okay, and then you have obviously the film. So there's two things in there. When you talk about the interest rate that is accrued, right? You said not fixed, it's just accrued, right? Like in terms of the ROI, that's 4 or 5%.
So we pay out twice a year. Again, I can't give an actual offering here, but it's like twice a year. We pay on February 28th. Or August 31st, but you get a daily accrual until those payout days. So you get paid twice a year on a fixed return, not a preferred. It's a fixed return.
Fixed return.
Right?
Okay, so
and that's what people want to know, something that's consistent.
Yes, right? And what I want to get at is that fixed return, is that pinned on the real estate side only? Because you have the
real estate side,
Yes. Okay. That's what right. So then how much? What is the range then on the film side? Because you're pinning this stability from the real estate, right, to the real estate, and you get stability from the real estate. So now, in terms of the volatility and the fluctuations that you get, what is the range here for the film? Right? Is it like a negative to a positive, or is it 0 to positive? I mean, I'm just kind of curious. What is that?
That one's case by case, because it depends on if we're working on our own slate. Are we working and co-financing a studio? Or are we just going to be like hard money? They also have that. We can lend against a tax credit on a film. Or we may be doing another independent filmmaker or other studio. They can actually bring the investors and go through our fund and use it as a vehicle. Because in my opinion, I bet 95% of real estate investors and filmmakers are raising money illegally because they're not filing anything. They don't know. So we're giving them a way to kind of through it through us.
Oh, I see.
And our studio. So that's another thing too. But no, I'll tell you a basic example on the real estate side. Usually you get 20% of your money. So you get if you put $1 million in, this is traditionally, let's say you put $1 million, the first $1,200,000 goes back to the investors, and then what goes above that, there's always a split. Let's just say 80-20, and then it'll go to some kind of threshold and go to 60-40, and then a threshold of 50-50, and so forth. So that's kind of like how a lot of the indies are done. And then in studio, they throw some crazy stuff out. Like sometimes if you're in equity position, you're in 7th on the waterfall or 10th on the waterfall, and then behind all these deferred fees, it's just a mess, really. So But yeah, it just really depends on what we're putting it in and who we negotiated with.
Well, are you able to, maybe without like divulging specific names of the projects, but just like talk about recent ones that you have been involved with, where, you know, on like case A, the return on the film industry side was more so this amount, right? And then on maybe another case,
so on the well, I can tell you three actually. On a equity side that we do, it was 120% return. So we got our money back plus 20%, and then it was a 50-50 split. That was one project. The second one that we was kind of doing is kind of like a financing one. Means let's just say that they had $1 million budget and they have a 30% tax credit. We loaned $200,000 against the tax credit, so it's like hard money, and then we got to make fees, and we also got we got to buy the tax credit at a discount, and then we also pushed like a small points on the back end in case the movie did good. So we got a small little deferred points there too. The another way that we done one is we came in and not only did we bring a little bit of equity and a little bit of financing, so we financed on the tax credit, then we added a little bit of a portion toward the equity piece as long as they had pre-sales, right? And the pre-sales kind of backed us. We also got producer fees through our studio, which was, in my opinion, really nice. And then we also get points on the back end.
Yeah. So, no, that makes sense. So this is exactly why you said what you said, and I see it, just even from this high-level overview, why people who are getting into this have to have at least $500,000, be accredited investors, and be a bit more sophisticated. Because with what you mentioned there are so many variables and moving parts that depending on what is the offer and opportunity in front of you, right, there's different ways to go about it to maximize that opportunity. Right. Like one is a peer, equity play with 50-50 profits. One was tax, like hard money lending against tax credits with a little bit of equity, I think you said. And then the other one, it's like a combination of creative financing, tax benefits, and and equity. And
I do want to say this for your viewers for sure. As you can see, I may be in the film industry, but I handle the real estate portion of the film fund, right? So I can speak the language a little bit in the film world.
Oh, okay.
We have people, and I can't even say what studios they're part of, but we have some really good board members that understand distribution, the packaging, and all that stuff for the film side. Basically, I handle the real estate portion.
There you go.
And I do understand what they've done. I'm just going to use different, like I'm using hard money. Right. I don't even know if that's what they call it on their side.
Oh, I see.
They're funding the tax.
I gotcha.
Stuff, right?
But so you have competent people within the film space that you're basically partners with, and that's 100%. The idea. Okay, I got you.
I'm the nerdy guy on the real estate.
I love it. Yeah. No, dude, that makes a whole lot of sense. And these people, right? Because it makes me curious. I know that in Hollywood they have the term, you're like an A-list celebrity, B-list, or C-list, or C-list type of actor, right? Actor, actress. So I'm curious, the quality and I would say certainty of you getting your money's back, or more than your money's back, right, is also dependent on who is going to get featured, right? Like if you get someone like George Clooney, Brad Pitt, Leonardo DiCaprio, whatever, right? It's like, okay, well, their movies are probably going to gross at a higher percentage or a higher level, however the film people break it down. So do you select projects, or do they select projects based on those criteria as well? I'm kind of curious. Yeah,
that is a tough. So I do want to say one little preface to the answer.
Yeah,
here
okay.
There's a movie called Obsession that just came out, right?
Okay.
There was no known casting. I don't think there's no A or B, and they had a budget of $750,000, and I think they just grossed more than $300 million. Isn't that crazy? So you don't have to have it, right? But us specifically, gambling on, would I have given them $20 million to do that movie with no cast, and no good director and no distribution plan? No, right? You see, that's where there's the risk, because there were 17,000 films done last year, and maybe a couple hundred, if that, were even profitable. That's how terrifying it is for me as an investor to look at. I'm like, what the world? Why?
Yeah.
These guys love their passion project. But to go with what you said,
man,
crazy triangle here. Okay.
Okay.
Is you got to have money to attract the cast. If you don't have cast, you can't get the money. It's really crazy. If you don't have a good director, the cast don't want to work with it. If you don't have the money, the director's not going to work with it.
Yeah, there's like all these variables.
Yeah, there's this constant juggle. However, talking specifically to what you were saying about the cast, is there's a thing called pre-sales internationally or domestically, right? So let's just say this is fake. I don't know, but let's just say that I'm going to use Leonardo DiCaprio because you mentioned him. What if I can get him to agree to do the movie, and let's just say his pre-sale, meaning if I just complete the movie before it's even started or complete, the international, they say, hey, we'll pay you $32 million for that movie, for the rights to use for a certain amount of time in Europe or whatever. I don't know. Now that might be kind of high, you know, he said 32 million. I say, okay, now we know we can pay Leonardo DiCaprio 20 because we're guaranteed to get 32 back. You see? So
on the pre-sales, yeah.
If you get a C-list actor, they may have a pre-sale of like 200 grand. You know, I don't want to name one, but like me, I'm probably going to bring that. But if you bring someone like an old childhood actor that hasn't done a movie since he was 5, it may be nothing too. You know, it depends. Yeah. But yeah, Leonardo DiCaprio, The Rock, Mark Wahlberg, like these guys have, I don't know what their pre-sale. Again, I am not I'm not the master in the movie part. That's what the team is. I just make sure I can understand it, and they show it to me to have a clear pathway to how we're going to be profitable. Yeah. And how we do that is if I don't see enough pre-sales for the actors, like you said, that I say, okay, if our budget is $25 million and we're giving $20 million to Leonardo DiCaprio, and we have $5 million for production, that's $25 million. But he's bringing in 32 on pre-sales just internationally. I also have to, then I'm like, okay, this is looking good. Like I'm feeling good about it. But then you got P&A, which we call PAD. That's printing and advertising. We call it PAD because it's printing and advertising and digital. That's what we changed it a little bit, right? Okay. Then that could be double. So even if my budget is 25 million, it could be 50 million is what it's going to cost to even do it. But I only have 32 million in pre-sales. So my gamble is that difference, that $18 million, right? Yeah. So then we want to have soft money, hard money, all that soft money would be, or maybe we want to do brand placement. We want Leonardo DiCaprio drinking at McDonald's. Actually, I miss McDonald's or something like in there. Or maybe someone wants to pay to play and be in the movie. I don't know. Like
I was just going to say, I thought about that. I was like, man, technically, if you're an investor that is passionate about the film industry and you want an in, this could be your way to like put your money down and be casted.
There's a movie that we just did in Athens, Georgia. I don't know if I'm allowed to say it, so I'm not. But this guy came in, they paid a little bit of money, and not only do they still get their return, right. Through our fund, by the way, we just connect them directly to help produce it with the producers. He paid money. And they got in the movie. You know what I mean? And they got a speaking role, right? So you can pay to play. So Philip, if you want to pay $500 million, we got some great projects for you, right?
and I can be featured to
killed in movies. I just want to get shot and killed in movies. I want to be the guy that dies in a bunch of movies. That's just be specific. I don't know. It's a dream of mine.
You could basically be pay to play and get really active and be a stuntman in that case for you.
Stuntman or die, or honestly just a good camera. It does help. Me and you were working on our personal brand. Look at us doing this podcast.
Right.
Imagine if you're in a few movies and then they
exactly. Yeah.
Your credibility.
Hey, I'll be the hitman, so I can help you. Right here.
Hitman who kills me.
Yeah, exactly. That's right. There you go. Look at that. We got our plan. Do you have a plus one? Can you bring me on as a guest if you're an investor or if you're part of the fund? You're like, hey, it depends on
it's like I said, we have to still negotiate with the other people who are that we're working with. If it's our slate, of course we'll work with you for sure, and we know you anyway. You know what I mean?
I love it.
$500,000, we're good. I'm just kidding.
Oh wow, I love that, man. So you're more so the expert on the real estate side, right? So break that down to the people. What does that mean? Does that mean that you actually are competent around not just the numbers, but like everything from start to finish? in regards to like finding the deal, like what the investors, they just worry about what putting up the money and that's it, and then just having.
Well, believe it or not, most of the real estate stuff that I used my own money, or I negotiated using creative financing.
Yeah.
But what happened, the only reason I started a real estate fund was because the sellers, when I went to cash them out, because they'd seller finance to me. After 4 or 5 years, I want to refinance and, pull out capital. And clearly I have to pay them off and get a loan now. Is them sellers said, Shane, we enjoyed the monthly income. So I said, well, I guess I can start a fund because they trusted me. We have a track record. And they put their money in my fund, and it's cross-collateralized amongst multiple properties instead of just one now, you see?
Yeah.
So it's something good for them, and it's interest only. So it's not like an amortization schedule where it's getting paid down now. So they treat it like their retirement. I have one family, I think we spend almost $32,000 to $35,000 a month went to them. And then when I cash them out, they lose in that income. So they're like, so they'd rather just invest in my fund and, have a good return. And yeah.
So are you able to disclose how much you have in your fund right now, and do you have targets for your fund? Like, where are you trying to get that number to?
Yeah, so we have two funds, two real estate funds.
Okay.
Both are going to be the tap raise that I put on is 20 million to raise. The film fund we're going to do at 150 million. We want to raise that amount. The private equity that we do, I'm going to start with 5-10 million. I haven't raised anything for that yet either.
Oh, okay.
And then, we want to go up to the $1 billion in assets.
I love it.
We have
so
specific properties in one of my fund that are really good. That protects all investors. That I can say that on one of them at least.
Okay, so hold on. So let me get this straight, right? So you have the private equity, which is the lowest, if I recall correctly, is 5 to 8 million.
That one yet. Yeah.
Okay, so private equity 5 to 8 million, right? Or 5 to 10, you said. 5 to 10.
We want to do 5 to 10 million first.
Okay, 5 to 10. Okay, that's private equity. That's the lowest, and then the middle tier is your real estate. But you said there's two of them. So because I heard there was I think 50 million for the real estate and then 150 for the film. But if there's two for the real estate,
each one of those are $20 million funds.
Oh, I see.
Raising, and the other one we're still raising for, or as I cash out my investment.
Okay, I got you.
Be raising capital. It's
I see.
150 million is what we're wanting to raise in the film fund, because projects, man, for film it's expensive. Like the one we're doing right now is a $20 million raise.
Exactly.
And we got to do it and start in September to be able to go for Oscars next year. And we have a gala November 8th that I'm sponsoring, so we spend a lot of money. November 8th. Red carpet event, and we're doing it right off of Rodeo in Beverly Hills. So you got to come.
Hey, if my schedule lines up, November 8th in Beverly Hills in LA.
Yeah.
I have something. I think the first week of November in Arizona. But I'll double check my schedule. It's for specifically actually a business acquisitions related activities. Yeah, but I mean, like I said, I'll look at it, and by the time we get closer to that date, I'll look at which one makes more sense. And good. If I can fly out there and support you, I always will, man. But that's cool. So 5 to 10 million for the private equity, 50 million combined for the real estate. But there's two different types of funds. So one is what specific, like in terms of how they different, right? Like what is one more?
On the real estate fund, what it is, I tapped it out at 20 million bucks. That's all. And then I didn't know that. So I said, well, I'm going to start another one and tap it out at 20.
Right. But okay. But the one that 20 million that's already tapped out, is it tapped out at, because it's the multifamily space? Is it the commercial space, or is it the hospitality space?
It's diversified. So we have some single family stuff in there. We have commercial. We have, it's mixed. It's mixed.
Oh, I
see. What I don't do is new development. I have it in the fund that I could do. I haven't done enough development. I
see. So does that mean that Gotcha. So does that mean that the second fund is basically the other 20 million is basically getting raised for the same exact deployment of capital as well? Yeah. Oh, I gotcha. Okay. Okay.
And I'm well.
I gotcha. But so you just basically have funds that are capped at 20 million, but the function of that fund is the same. You're just basically duplicating those, and you're capping them at 20 million to categorize and segment them.
Yeah, I think that's a good way to kind of categorize.
Yes,
it out.
No, it is. I love it, man. I love it. Hey, look, I know you're a busy guy. Thank you so much for showing up, for breaking down how exactly your one and only structure of combining real estate with film and private equity works, man. I'm super excited to continue the conversation because next time we get together, we're going to go into the tactics. We're going to go deep on specific teaching points, and that I'm excited for. Thank you so much, Shane. For the people listening, if they want to learn more, if they want to get a bit more access to you, to the team, to start a conversation about these things, what is the best way for them to get a hold of you?
Yeah, you guys can find me on Instagram, YouTube, TikTok, Facebook, and it's at Shane Seo, and Shane Seo is spelled, so it's at ShaneSeo. Guys, make sure to follow me, DM me. I don't use AI responses or anything like that. So if I respond to you, it's me directly. Would love to stay in touch. Let me know you came from this specific podcast too. Would love to stay in touch.
Yeah, hey, it's Shane Seo. It's basically SEO in one human being. That's how you can remember it, man. Yeah, I
optimization. Yeah.
That's right. That's right. On optimization on all things real estate, film, and private equity. Thank you so much again for your time. I hope you have a great rest of your day, and I look forward to seeing you again next time.
All right. See you later, man. Thank you very much.
Absolutely. Take care.